Let me just, check my microphone. Is it working correctly? Okay, GM everybody, or as we would like, we who are very passionate about zero knowledge technology would like to say ZM from the release of the Polygon ZK EVM recently. My name is Ajdin Kahrovic. I'm an engineer at the OVX protocol. And the topic of the presentation that I'm talking about today is real-world assets and how they can drive DeFi 3.0. And before going into the topic of the real-world assets, let's kind of first dissect the narrative of DeFi 3.0. So what actually is DeFi 3.0? In order to define, let's kind of step back a bit and let's talk how basically what would be like DeFi 1.0 and then what's DeFi 2.0 and then basically what we actually trying to achieve with and what we think that the DeFi 3.0 is. So when we say the DeFi 1.0, we think about the first protocol that appeared into DeFi space. These protocols are actually the protocols that define what are the current DeFi primitives that we know currently about. So when we say DeFi 1.0, we think about the first protocols such as Uniswap, such as PancakeSwap, such as Aave Compound, and these are kind of protocols that define what are the liquidity pools and what are money market protocols there, and what kind of a protocol and what kind of utility it could give to the investors and to the community that are currently tapping into the DeFi space. What DeFi brought in these kind of first years of a DeFi, which was 2019 or 2020, were basically they brought decentralization as a core concept and the self-custody to existing crypto space that existed. Before that, most of the trading, most of borrowing and lending was happening through the centralized exchanges and through the centralized systems. DeFi, when it was introduced, it offered people opportunity basically to continue with the self-custody and to continue using the whole crypto system in a decentralized manner. So it allowed people to provide liquidity. It provides people to harvest additional yields through borrowing and lending of cryptocurrencies without making compromises about the self-custody, which was kind of one of the core principles why people actually use the cryptocurrencies at all. So that's kind of the thing that DeFi 1.0, in our opinion, tried to solve, and it successfully achieved. It actually brought the DeFi summer of 2020 and 2021, when we all kind of, many of people actually were introduced with these concepts and started using the cryptocurrencies. However, it had, and still has, because it's still the dominant way of using a DeFi, many of the issues, and primarily it faces the issues of a capital inefficiency. For example, when liquidity providers provide liquidity to the, for example, to the Uniswap V2 pools, first they are kind of prone to huge losses due to the impermanent loss, even though they make a certain money through the trading fees. Also, they get LP tokens as a proof of them providing liquidity. However, they can't do actually much with them. Right. So within this kind of a first DeFi concept, we were introduced with the yield farms, where could people kind of stake these LP tokens and earn some additional yields. However, these yields were not sustainable at all, because these yields were coming from the most frequent case would be that these yield farms would provide people with a native protocols token, which is not a sustainable way of incentivizing liquidity providers. Also, the people were not using that much money markets, etc., etc. So basically, the DeFi 2.0 came as a solution to this kind of capital inefficiencies that were introduced at the first place in the DeFi space. Examples of these kind of more capitally efficient protocols are those where the users can, for example, use their LP tokens as a collateral and then borrow on top of that. These kind of things increase the capital efficiency. Also, there are many protocols which are trying to bring under-collateralized loans over the standard way of over-collateralizing loans that was introduced in the DeFi space. Also, there are examples of these enhanced liquidity pools, such as Uniswap V3 pools, which allow that people specify more narrow bounds of the liquidity, basically to allow that most of the capital that's flowing into these liquidity pools is constantly used by traders in that sense. And then comes the DeFi 3.0. So it really, there's no, it's narrative, as I say, so there is no common consensus if these kind of division all exist between 1, 2, and 3, and what the DeFi 3.0 should actually represent. However, what we at OVIX identified as a DeFi 3.0 is the way of using the protocols in a way that will allow, first of all, to have a unified liquidity across multiple chains, because currently the whole system is quite fragmented, and it requires users to do a lot of research about security of the protocols they use, that they need to kind of constantly monitor the APYs that they are seeing in these protocols. And that, in that sense, it represents certain way of preventing the massive adoption of the users. When we say the massive adoption by the users, we also are trying to address the normies, as we call them, as opposed to the degens. So basically, we think that in order to have a massive adoption of a DeFi, which would lead to real sustainable yields in the DeFi space, we need to have much more users than we currently have. And in order to achieve that, we need more traditional type of the investors, more traditional type of the people in the DeFi space, so we can basically achieve all of that. And then the question is how to basically get to the massive adoption. And we kind of identified, let's say, like 3 very important, maybe these are not the only things that are currently missing, or that the things that will that have a chance to solve this issue of very relatively low level of participation in the DeFi space. So we think that right, I mean, self-custody really matters to most of the people who are already in the DeFi space, and it's a really important part, but it's also very difficult. Many kind of people are not used to installing the MetaMask in their browsers, not using to signing the transaction, not used to taking care of their private keys and seed phrases. So we think that introducing the account abstraction, which we see through, it's supported natively on certain chains such as ZK Sync, or it's supported on EVM-based chains through ERC-4337, I think, the new standards for the account abstraction. And what we expect from it when it becomes a standard, and I hope it will happen in the next year, is to allow creating wallets as a smart contracts, and allow users not to actually need to remember their private keys, not need to remember their seed phrases, but they can use a social recovery if they want, and they can manage all basically the transactions on even multiple chains through a single wallet. And I think that will kind of remove this huge blocker for the mainstream adoption that we need. That's the first thing. Second thing is the layer 2. As you know, Ethereum, like the most secure blockchain supporting smart contracts, is not scalable enough by itself. So there is this kind of very famous blockchain trilemma, where basically the scalability is sacrificed for the security. And in that sense, we see the layer 2 solutions, primarily Polygon ZK EVM, ZK Sync, but also the Starknet and many others, as the way basically to make this scalability much more achievable. What we hope to see is the low costs of the transaction and high transaction throughputs through them. And we think that, you know, the absence of these kind of very slow and costly transactions are also something that prevents the massive adoption, especially in a kind of day-to-day payment. So if you need to kind of, if you go to a cafe and you need to pay a coffee worth of a couple of euros, and then you need to spend the same amount on paying transaction fees on Ethereum for that, that's no-go for many people. So I think this will also bring a massive adoption. I actually hope to see that. And the last thing, which is kind of the most important for this presentation, is the real-world assets, which are currently missing in the DeFi space. Mostly, even though we see, and I'll talk a bit later about this, we see certain protocols trying to address this issue. Why these real-world assets are important? Because real-world assets are bringing real yields to DeFi, right? So when I say real yields, that's kind of the opposed of these kind of yield farming protocols or yield farms, which kind of continuously mint new utility tokens of the protocol and trying to kind of, you know, to bring up their yields, but that's not sustainable at all. So we think that's crucial to bring real yields to the DeFi space in order to achieve more wider adoption there. Real-world assets would bring new asset classes which have really much larger addressable markets, and I'll show that on the next slide. But they will also bring a transparency. So this kind of bringing real-world assets to the blockchain it brings advantages on two sides. So for a degen side, let's call it like this. So for the existing users, for the existing protocols, it basically allows greater composability. So the real-world assets, in that sense, for example, can be used as a collateral on existing DeFi protocols, so that people can borrow against these real-world assets. It also kind of increases accessibility in a sense that many people in the world are kind of currently excluded from the financial systems. That especially is dominant in developing countries in the Africa, Southeastern Asia, South America, and many other places, including the Balkans region, where people cannot easily participate in a security market. They cannot very easily buy bonds and things like that. So in that sense, bringing real-world assets to the chain will increase the accessibility to these financial systems by many people. And finally, there is a transparency. This is like a great advantage over having real-world assets off-chain, where you can easily track who's owning what, who transacted what, and things like that. But you know, the kind of short term, the biggest achievement that can be used with bringing real-world assets to blockchain is basically bringing real yields to DeFi. And therefore, we think that it's essential to bring real-world assets here, so we can go to the mass adoption, and then we can go to DeFi 3.0. And speaking about real-world assets, we see it as basically a utility via crypto rails, as I say here. And this chart is from Chainlink's blog post, which basically talks about the total addressable market of these real-world assets in case that they are tokenized and they are brought to the chain. They have like really huge numbers here. Then you can see, you know, how big the stock market is. It's $19 trillion. There is a global real estate of 280 trillion. There is derivatives that are built on top of it that are worth like 1 quadrillion. So these are like huge numbers that Chainlink is showing in the blog post, but they are kind of real. It doesn't mean it's, as I said, it's total addressable market. It doesn't mean that, you know, we can very easily bring this much of the value to the chain, and it will, you know, years and probably decades will pass even before we kind of grab like a very small portion of it. But it shows, you know, how big is the financial market within which these these assets are being traded and issued and traded there. Yeah, they also call this the market for trust minimized application. That's what we usually, this is kind of the alternative name to the Web3 applications. There's some kind of very small differences what they mean, but that's kind of, this term is bring as opposed to centralized applications and applications that require a lot of trust, so the trust minimized applications. So it's hundreds of trillions, even in quadrillions, that's currently measured. However, what we very often don't see is that real-world assets already exist on chain, and we have stable coins, which are like the first real-world asset with a product market fit. So we have dollars and also some other currencies, but with much less adoption. However, we already have a dollar as a real-world asset, as tokenized and represented on the chain. So this is like the first thing that already found the product market fit. However, there are many more of them that have a potential to be tokenized. There is excellent website, I didn't put it here, it's RWA.xyz, which kind of provides a very nice dashboard about the current state in terms of tokenized real-world assets or real-world assets that's brought on chain. And they have several categories of this, and they're kind of following which protocols are doing what in that sense. And then we can see, using this dashboard, like a ton of the examples of real-world assets that could be tokenized and brought to the chain. There are private credit, so giving the loans in different ways and different shapes. What we at OVIX are specifically interested in is the trade finance, or having these invoices tokenized. I'll speak about that a bit later. But we also have a securities. If you were long enough in a Web3 space, you would remember that 2018 and 2019 there was a big hype over the security token offerings. I was actually also at that time building one of the security token platforms. However, it didn't find its product market fit as it should be. I'll also talk about why not. But the securities were kind of also very obvious example of real-world assets that could be tokenized and brought to chain. Also, there are real estate. That's like the first thing that comes to the mind of people when thinking about what can be tokenized. So basically representing the real estate as a token, whether NFT, whether fractionalized in a ERC20, and then basically it can be offered to the liquidity providers in a different ways and different shapes. So, for example, people can issue these tokens representing the real estate, and then basically they can do a partial equity release, so they can earn money by releasing it. People can join the funds using the ERC20, buy the real estate, rent it out, get the rent as a yield. People can tokenize the real estate that they own and use it as a collateral on money market protocols to borrow cryptocurrencies against real estate, or not only cryptocurrencies, but other real-world assets, for example, stable coins, etc., etc. So basically, there are so many different utilities that could be brought with tokenization of the real-world assets, which is very so. And that's why, again, I say that we see it as a very important part of the massive adoption of blockchain. I will not go much into the details about real-world assets. As you know, this morning there was a presentation by Adam from the D-Factor, who was kind of explaining how this process of tokenization goes, how they do it. It was a very good presentation. For those who were not there, you can watch it afterwards. But you know, as I'm kind of very constrained with the time, let me kind of think in the why this kind of a fairy tale of bringing the real-world assets to the chain and achieving massive adoption in that sense is is kind of very, not very far, but it's still not achieved there. So I created this kind of a triangle consisting of regulations, technology, and market, which is kind of the Bermuda Triangle, in which many startups gone missing because, you know, because some of these aspects or the challenges of tokenizing real-world assets basically stop them from continuing to exist and to kind of offering their products. The most important among them all is the regulation. Regulation is changing, so it's not the same regulation now that we had in 2017, 2018, when these kind of the first projects of tokenizing securities were tried. At that time, there was no any regulation that would actually allow that. However, things are changing currently, but the fact is that when you have a tokenized real-world assets, first you face with the issue of the custody. So basically, you have a real asset in a real life, and then you have its representation on the chain, and then basically somebody needs to take care of the physical asset that exists there, if it's physical. So if we see the example of, for example, tokenizing classic cars. So if you tokenize a classic car, you can have an NFT, but who's going to take care of the car? And who we are going to trust to take care of this car? The same goes with the real estate. So basically, who's in the land register, who's going to be written as the owner? And also, who will take care that if this property is to be rented out, that it's rented out properly, that it's maintained, and things like that. And when we have this kind of custody issue, then it also brings a lot of regulations by itself. And most of them are actually very justified regulations because they're trying to protect the investors. But due to these kind of regulations, which apply in the same way on the assets that are on the chain as if they were not on a chain, it means that these startups who want to engage in the tokenization of them would need to get a bunch of the licenses depending on first what kind of assets they are tokenizing, and then based on the jurisdiction when they are operating. And what's kind of more limiting to the massive adoption is they need to comply with the regulations from which the investors come. And since the blockchain is trustless and it can be accessed by any person from any jurisdiction, it creates a very, very big paradox in which, you know, people, or not people, but startups and the protocols are facing issues and do not know how to solve this. However, these regulations are slowly changing. They are not the same for all the types of real-world assets. So if you are basically offering tokenized securities, you need to comply with these with security-related laws such as MiFID in EU or MiCA from recently. But also, if you are doing the tokenization of the invoices, then the different set of the regulations apply there. Regulators are following what's happening in the space, especially the regulators coming from developed parts of the world, primarily US regulators. And there's kind of different approach by them. Some of these regulators are very prone to kind of working together with these protocols, with the DeFi world, to make this possible. Others are trying to kind of kill it at full there. However, one important thing there is that these regulators, for example, central banks, are often seeing DeFi as a big threat to the investors, primarily because they think that there is no proper risk assessment framework. So they ask, okay, so if this goes to mainstream, and there are kind of flaws in the system as itself, and we've seen many of the DeFi flaws already. They could kind of damage the financial stability of the countries in which we do regulate, which is partially justified argument, and it brings kind of necessity for these protocols working in a real-world asset tokenization space to kind of build their own risk assessment frameworks to make investors as protected as possible, and to kind of remove these flaws to the way it's possible. Next thing is the technology, which is, in my opinion, I'm an engineer, so the technology is easy. You know, it's when you know something, it always seems easy, and what you don't know much about, it seems very hard. But the technology itself has also its limitations. There are also technical challenges. First of all, there is no kind of massively adopted and agreed upon industry standard. So there were many attempts to do so. We've seen different ERC standards trying to, or apes, trying to standardize these tokens. If you maybe remember ERC 1400, trying to describe what the security token is and how it's different from ERC 20. For example, it needs to have a compulsory takeover, because if you have a security, then you need to have the ability on-chain to take it from somebody's ownership, for example, in case of the sanctions, in case of the death, and things like that. So that's like the first challenge is in terms of the technology. Many of these real-world assets require, the regulations require that the owners are known to the governments. So in sense of a DeFi, these protocols would also need to implement some way of a KYC or AML, so know your customer, anti-money laundering operations that should happen directly on chain. And that's kind of also quite tricky. However, there are also many products that try to solve this. Maybe you've seen Polygon ID, it's one of these attempts to address this issue. But as I said, the technology is like the least troubling part for tokenization of real-world assets. The final part is also as important as the regulation, and that's how to properly address the market, how to find the correct product market fit in that sense. So the first problem is that many protocols struggle to determine, are they addressing the degens or existing users of a DeFi space who prefer the self-custody, who are very used to using their wallets, to paying for the transaction in the native coins of the chains they use, which are very used to kind of having very high yields on the assets they use, which was kind of what we've seen, like hundreds or thousands percentages of the APY in the bull market, but they were mostly using the yield farms. So basically, how to approach these degens with the kind of very boring products such as bonds, for example, which bear like 1 or 2% APY. On the other side, if you are going for the normies, and if you're going to the traditional people, if you're going to the traditional investors, how basically to make them use something that requires so much of a technical knowledge to use, and also how to kind of make these people or attract these people to trust the general crypto space, which is by many still seen as something very, very scammy, I would say. And what's kind of very important, in order to kind of, address, So if we're going to address like one or two of these dots, we need to talk with institutional players, the institutional investors in the space, because most of the capital that's going here goes through the asset managers, it goes through banks and other players in the financial markets, which are kind of very they have a very different viewpoint over the tokenized assets, about digital assets as they are currently. One of these reasons is because they are scared of the regulations and they need to comply with all the regulations. They're on the second part, they are also afraid of potential flaws in the system, and these kind of the things are actually what's kind of preventing many protocols to find a nice product market fit there, and they would eventually go on missing within this Bermuda Triangle. And let me just quickly, because I'm running out of the time, explain what we at OVIX are currently doing about this and how OVIX is trying to be relevant in this tokenized real-world asset space, and also what they mean for us. So OVIX, not sure if many of you know for us, we are a money market protocol. We are very Polygon native, so we exist for some time already on a Polygon POS. And we allow users to lend and borrow like any other money market protocol, blue chip stable coins, but also we introduced many more kind of exotic assets, let's say, which are not what you could see on for example, Compound V3, such as liquid staking derivatives, also some other assets, synthetic assets like Volt tokens and similar. We have some kind of things that differentiate us from other competitors, but that's not relevant for this presentation. What's kind of very interesting about us that we were also the first protocol to deploy on a Polygon ZK VM, and which was released in March this year, and it resulted with Vitalik sending us a message on chain. If you were following what's happening in a Polygon community, there was this ZK VM lunch party. Vitalik was the guest there, who kind of sent like the first transaction. He chose a random address that he saw on an Etherscan that was transacting already with the Polygon ZK VM, and that was us. He sent us like a very tiny piece of ETH, and also this message: a few million constraints for mankind, unconstrained scalability for mankind, which is kind of, you know, for us, very immortal message, and you know, the kind of the proof that we are on the right track in terms of the Polygon ZK VM. And you know, what do we do with the real-world assets? We are currently looking to allow our community and our investors, which we have in a couple of thousands, to tap into the real-world assets. And the first thing that we are kind of taking a very easy approach with that is to integrate with a company called Polytrade, which does invoice financing. So what's invoice financing? It's a way in which it's generally a very huge part of the financial markets. It assumes that there is a supplier selling any type of the goods. Very often it's exporter, so it's import and export type of a business. They are sending these goods, making the invoices, but these invoices are not paid immediately, but only when they agree upon with the buyer. So many times the buyer is the one getting the goods, but paying much more later. And supplier wants to get money as soon as possible. The buyer wants to pay as later as possible. And then this kind of invoice financing or the trade finance comes in. It exists for many decades already, where there are certain financial institutions offering a type of a loan to these suppliers, to be, in a sense that they pay this invoice immediately after the supplier pays, and then when the buyer pays in the end, it allows supplier to return the loan. And since this is like a huge, like probably in billions of dollars, big industry, the Polytrade, the company we are working with, basically brought this invoice financing to chain. So what they do, basically, in cooperation with us, what we actually do is we set up the pools. These kind of the pools this is from our application. So we set up these pools which are denominated in stable coins, in USDC in this example, and we allow our investors to deposit money. Then we pass this money to Polytrade, and the Polytrade basically uses for financing the invoices. Whenever one supplier wants to take a loan, to have their invoice financed, the Polytrade issues the NFT for them, which basically shows and associates this NFT to specific pool on our site. So we know basically, or our investors know, which exactly invoices are going to be financed using these pools in which they are putting money. And basically, as you can see, these invoices produce very large yields, but the most important thing is that they are real yields. So these yields are paid by the supplier, who basically pays this interest so that they can get money as soon as possible, and then basically this yield is passed to our investors. So we have the opportunity to offer our investors real yields, and not only real yields, but also to invest with the stable coins. So it means very little risk of volatility, and also very high yields and very low risks. So this is something that we are going to release in a month or so, and we are really looking forward to see how our community is going to look at it. But we think this is kind of a very nice way to introduce the real-world assets to our existing community, which consists mostly of, as I said, a degen population. And that's it about it. I think that I crossed the time heavily. Sorry for that. I tried to be very condensed here, but if you have any questions, I'm here to answer. Yeah. Okay.
Yeah, first of all, nice presentation.
Thank you.
So I really enjoyed it. Regarding the polytrade, so how do you establish the reward percentage? So how do you know it's 26% or 30% or something? And the other thing is, what happens if the buyer doesn't pay?
Yeah, okay. Thank you for your comment and for the question. It's a really good question. So basically, we determine this APR by the contracts that are being signed between the supplier and the polytrade on that side. So just besides just issuing the NFT, there is a contract which says, okay, for these invoices, these invoices will be paid in 90 days, for example, and this is the interest rate that's going to be paid on top of it. So basically, this is how, and then basically polytrade sums up all the invoices they have, which are associated to specific pool on our side, and then we calculate based on that the APR. What happens in the default situation is that the polytrade is in Dubai, is in Emirates, and they're compliant with their law there, which means that in case of a default, first there is So in terms of a default, they could go to the court in Dubai to basically sue supplier or buyer in that sense, but to prevent kind of this happening and affecting this kind of process to the investors, there is insurance on top of every invoice, so they are quite insured. They actually have much higher interest rates are being paid by the suppliers and actually buyers there, but the very big portion of it goes as well to the insurers, which makes sure that these funds of the investors are safe. Okay. There was one more question here.
Hi. So most of the community uses the term real-world assets for the RWA. Dune Christensen, for whatever reason, uses risk-weighted assets in all of his communication. And MakerDAO is one of the biggest users of RWA. So can you explain why? I really tried to Google why. And can you explain why this dichotomy, if you know? Risk-weighted assets.
Oh, risk-weighted assets.
So he never used the term real-world assets ever. He just uses risk-weighted assets.
Yeah, I don't know really why, but what my assumption is that there is kind of very different risk assessment process in terms of real-world assets in comparison to exclusively digital on-chain assets, native assets, which we used to see. First of all, in that sense, they are more they're less risky because they have a real collateral. If that's real estate, then there is a house that really exists there. So the risk is lower in that sense. On the other side, the fact, looking just from the on-chain perspective, there is much more risk involved because you are not able to see all aspects of these assets that exist. As you can see with the, Matic or ETH, you can see the total supply on chain, you can see who's the holder, what's happening with it. So everything is traceable by the on-chain. On the other side, there is a certain risk involved with this custody there, which on the other side increases the total risk of holding it, because what if this custodian of these assets that exist in real life is scammy, wants to do something wrong, makes certain mistakes? What if this house burns down? What if these securities lost value due to some off-chain events and things like that? So I think this is mostly related to a different way of assessing the risk in terms of the natively existing assets on chain and these who are tokenized. Here. Any more questions? If not, thank you very much.
Thank you, Ajdin.